looking at the affordability crisis and looking at the demographical destruction that's happening, it makes me have some disbelief in a continued euphoric real estate market for decades to come.
We've transitioned from a period, coming out of COVID, where expectations were pretty depressed and the economy was pretty weak, and there were some real concerns about a tightening cycle slowing the economy, and you saw a little bit of a pullback in 2022. Yeah. But at this point, we basically have near euphoric pricing across most equity markets.
Information presented on this program is believed to be factual and up to date, but we do not guarantee its accuracy, and it should not be regarded as complete analysis of the subjects discussed. Discussions and answers to questions do not involve the rendering of personalized investment advice, but are limited to the dissemination of general information. A professional advisor should be consulted before implementing any of the options presented. Encompass More Asset Management LLC is a registered investment advisor with the U.S. Securities and Exchange Commission and only transacts business in states where it is properly registered or is excluded or exempted from registration requirements.
Hey guys, welcome back to another episode of the Tall Oaks podcast. I am joined by a special guest today, a friend of mine, Bob Elliott, who has had a very intriguing career and done some cool stuff. Bob, I'm going to give you a short introduction if you don't mind. Correct me if I'm wrong on any of these. Worked at Bridgewater with many people might be familiar with Ray Dalio. Well, Bob was actually on the investment committee at Bridgewater and had a pretty lengthy career there, and now runs his own fund company and writes the Nonconsensus Substack that's available. Which I think is a really interesting read, Bob. Nonconsensus, obviously for anyone listening, means like Bob doesn't always think the way that everyone else is thinking. And that's valuable in financial markets because, listen, like if you want to know what the consensus is, just turn on CNBC and, it'll tell you what the consensus is. And we kind of know as investors, the consensus is generally wrong, right? So Bob's got these non-consensus views, and that's what we're going to talk about today. I think it's an interesting time of years. Everyone's looking to reposition portfolios, make maneuvers, tax decisions. You're looking at your income planning for next year. And you start to wonder like, well, what's the market's going to be like? I know that I recently was talking with a client that said, well, I think next year is going to be a really good year. And I said, okay, really? How come? And Bob, their answer to me was, well, this year was so volatile, so next year should be pretty good. I said, oh, I'm not sure that's how that works, but maybe it is. What's your thoughts, Bob?
Well, I certainly, first of all, thank you for having me on and appreciate it. The idea of non-consensus is in many ways just a reminder to myself and any market participant that in order to create alpha, you have to have non-consensus ideas, which almost inevitably when you have them, you've struck a chord. You have a good non-consensus idea when you piss off about 80% of the people that you're talking to with whatever you're saying. So that's hopefully I don't anger too many listeners of this podcast when I talk about what's going on. I think to get back to your question, this year has been a great year, like in the context of how equity markets typically perform. This has been about as good as you can expect, up 15%. I think many people are their experience is colored by two previous years, which were essentially the best 24 months on a rolling 2-year basis in 150 years. And they're like, oh, wow, this year is terrible. But no, this year was a great year, another great year for the market. And so I think, extrapolating that you're going to get not just 3 fantastic years of performance, but then on top of it, another year and another year, that's really when people's expectations start to really extend in a way that may not be realistic.
So what you're essentially highlighting there is like the markets have actually been pretty good the last couple of years on a historical basis, almost too good for too long, right? Like, I mean, is that essentially what I'm hearing?
I think what you're seeing here is that we've transitioned from a period, coming out of COVID, where expectations were pretty depressed and the economy was pretty weak, and there were some real concerns about a tightening cycle slowing the economy, and you saw a little bit of a pullback in 2022. But at this point, we basically have near euphoric pricing across across most equity markets. We have, whether you look at PEs or you look at say earnings yields relative to bond yields, or Schiller PEs, or all the different ways that you can look at valuation metrics, and implied earnings growth ahead. And basically the expectation is that pricing in the markets is that things are going to be great, not just, I think importantly, not just for, say, the Mag 7 or the AI names, but really what's expected is great earnings growth across the economy, double-digit earnings growth for the next couple of years across the economy, which implies that any of the benefits that we're seeing in sort of the AI names have to expand out and also benefit what I describe as sort of the real economy, when, at least so far, we haven't really seen that sort of benefit play out.
Well, we haven't seen it in the stock prices either, right? So as a technician, one of the things I'm looking at is like what's happening under the surface on a lot of stuff. Because when we talk about, like, it's been a pretty decent year, you talk about that at the index level, right? So the broad indexes that are skewed really heavy towards the big tech companies, right? The Facebook, Nvidias, Googles, Metas, all this kind of stuff. Like, those have performed well. But if you look at mid cap, smaller size companies in the U.S. or even actual small caps, or you look at, even just some of the components within the S&P 500 and some of the larger companies, but they're not beneficiaries of what is effectively like this AI Capex trade. They've had a lot of volatility and struggled, and they're not exactly pumping out returns the same way, right? So if you've been a stock picker in this market and your stock picks weren't, lean all into the AI trade, right? It wasn't press the Mag 7, then it becomes, it has been a very challenging market, and it's because those companies in what you're calling the real economy haven't been the beneficiaries of that. So is what you're highlighting that either this AI trade now needs to develop into sort of, stage 2, where now the beneficiaries become the users of AI, or we face some issues because we are priced to perfection that has to sort of happen in order to keep the party going?
Yeah, I mean, as you know, if you could just contrast, for instance, the equal weighted S&P 500 versus the market cap weighted, and the equal weighted S&P 500 is a better measure of sort of the real economy, since sort of the average company is much more the average company mix, I should say, is much more reflective than the market cap weighted, and equal weighted equities have been flat for a year, which has not been particularly compelling from a return perspective.
Yeah.
And I think that highlights that the real economy is that's pretty consistent with the real economy being soft. We've seen a transition 23, 24, the real economy is running at 2 to 3% real. We've seen a much weaker real economy over the course of this year, from a variety of different factors, whether it be just sort of the natural decay as you get later cycle, and higher rates sort of eat away at economic expansion, combined with negative growth policies from the federal government on immigration and on tariffs. And all of that is sort of chipping away at the real economy. I think that the challenge we see here is we're seeing still priced in, even at these levels. Remember, we're still at essentially all-time highs for even the equal weighted S&P 500. Even at these levels, expectations are still elevated. And particularly when you look at earnings expectations for the 493 for the equal weighted index, people are still expecting pretty good earnings ahead, and the real economy is weak, and then on top of it, AI names are expected to have phenomenal earnings ahead, even though the real economy is weak. And this is really this is the late cycle conundrum, where essentially expectations are super elevated, in terms of, market expectations of future growth, and the real economy is deteriorating. And the reality, I think people often forget, is markets always eventually move to the future economic reality. They can't diverge from economic reality for all that long.
I think that's true. It's the old saying, right? So like fundamentals don't matter right now, but they matter eventually. But I think you have to couple that statement always with, markets can stay irrational a lot longer than you can stay solvent, is the old adage. When it comes to earnings and this pricing for perfection, but we're seeing some softening of the economy and the data. Is that something that you foresee there being continued softening, or it's a light patch that should eventually turn into a broadening of the market participation, right? Like what direction are you seeing this move?
Well, I think we've transitioned to a lower sort of medium term growth rate in the U.S. economy, and folks may not have sort of fully appreciated that that's where we're at. And I think there's a lot of talk about AI names and AI Capex and stuff like that, which couldn't, even at $400 billion a year is only 1% of the U.S. economy, or touch more than that. Whereas what really drives the U.S. economy is consumer demand. It's 2/3 of the economy, give or take. And what we've seen there is we've gone from a period where household income growth was growing at 6, 7, 8% nominal, to a period today where household income growth is at 3-ish%, 3 to 4% nominal, in an environment of 3% inflation. And you put those two things together, and that's going to lead to pretty subdued real demand from households. And we had that sort of dynamic was showing up early in the year. There was a bit of a reprieve over the summer. And now when we look at the more timely data, what we see is that weak demand is back. So for instance, today's retail sales numbers, the retail sales control group, once again contracted in September, and is likely to be soft in October and November. And so that gives you an indication of, for all the hype and hope that the economy is going to be able to essentially accelerate here, like labor markets are extremely weak, demand is showing signs of being weak, the housing market's weak. Like this is not a strong economy on the fundamentals at this point.
Yeah. You mentioned the housing market. I want to talk about that for a second. One of the things that I'm always hearing, I live in a community that is very involved in real estate. A lot of excitement around real estate, a lot of agents, mortgage lenders, home builders, you name it. I oftentimes hear the phrase, real estate has made like the most millionaires in history or whatever, which is always a funny quote because it was, they never know where it came from. But it came from Dale Carnegie, and he made it up. Is the actual answer. He just made it up giving a speech one time because it's like what he believed or he thought, right? And I always scratch my head and I go like, okay, well, even if that's true, how many bankruptcies did it cause? Right. Mm-hmm. So the net number that survived on the other side of this mass of people, trying to play the real estate game, how many people did it wipe out, right? Because real estate can become this all or nothing game because of the leverage that you effectively have to use in order to win the real estate game. So I'm always very interested in real estate. And one of the things that I always hear in sort of the circles within my community are mortgage rates are coming down. The Fed's lowering the rate. So interest rates on houses are going to come down. The mortgages are going to come down. And when they do, prices are going to run. They're going to be off to the races. Prices are going higher. As soon as the rate comes down, prices are going to offset it. The best time to buy is right now always, and I think that's obviously comes a little bit from a sales perspective, right? But it's the reality of what people think or believe, regardless of maybe like, I think some of it is just that they don't understand the mechanics, but that is really what they believe. So you mentioned a weak housing market. where are you seeing that? What's your data? What's your, how are you coming to that conclusion? What does that mean? Weak housing market in general, right? Like, how do you define that?
Well, I think there's a couple of different ways to think about housing. The first, essentially, in terms of the leading indications of housing, is what does that balance look like between those people who are selling versus those people who are buying? And when you look at a number of different third-party triangulations, what you see is essentially across most geographies, not all, but most, you have you have a buyer's market in the sense of there's a lot more sellers coming to the market than there are natural buyers at existing mortgage rates and existing prices. And I think what you're seeing that translate into is that builders are recognizing that there's this is probably not a good time to be building. And so you see real economy activities like permits once again declining. You see employment starting to roll over in the housing market. And you see overall pretty subdued views from the home building sector, and that's important because home building directly affects GDP and has second and third order consequences. For most homeowners, what really matters is, of course, prices, because that's how wealthy you feel. And so far, prices remain at all-time highs or close to it. I think the challenge there is that in a market where it's very normal for it to take time to have price discovery, and folks believe that maybe mortgage rates move down 50 or 100 basis points and now we're back off to the races. But when it comes to from an affordability perspective, the current level of affordability in houses, you look at essentially expected median payment relative to median incomes, is the worst since the peak of the housing boom. And so, and mortgage rates moving 50 or 100 basis points does essentially nothing to that. To get to something that's close to pre-COVID affordability, you'd have to have mortgage rates at 2 to 3%, and you'd have to have prices come down something like 15 to 20%. And that's a combination of dynamics that we're so far away from that I think probably sort of shock people when you say it, but those are the mechanics and those are the numbers. And so I can't imagine that we're going to have a sustainable bottom and reacceleration in housing until we get to a point where that sort of affordability is in place.
Yeah. I know I have some real estate agents in my office, actually. Good guys. And I had mentioned, I brought your viewpoint up to them, and they said, well, if mortgage rates go back to 3, man, prices are going to explode. And I was like, first off, I think we have to think, how do interest rates even get to 3%? What does the environment look like that gets us to 3? And
you don't want to live through that environment right now. That's all there is to it, right?
I think there's going to be less qualified.
Mortgage rates at 3 means that we're having a deep recession.
Yeah, basically, right? So even though you would think, if you survey everyone today and say, hey, if you could get a 3% mortgage, would you buy the home? That's one thing. But if you said, hey, in the context of what economy constitutes a 3% mortgage rate, would you still feel comfortable buying a home, and would you still qualify? Right. And
what would be the supply at that time? I think that's like, it's been so long since people have lived through a true housing bust that they forget, like, the way it works is, if the economy, sure, interest rates fall a lot, but like, if the economy's bad, then people put their homes on the market because they need the cash, because they can't pay the mortgage, right? That they can't pay the mortgage, so they put the home out. And so you get a big flood of supply just at the time when, economic conditions are bad, where people are losing their income. And so, like, each one of these pieces intersects with each other. And so you have to get to a point where, you have the interest rates low enough, combined with, the economy is rebounding, combined with prices having fallen enough to start to create that bottom in demand. And it seems like people have amnesia about how this worked 15 years ago, post GFC. Like, house prices fell 50% and interest rates went down hundreds of basis points. That's how we found a bottom.
Yeah. Well, the interest rates have to chase the price, right? They do. And the reason why is you're trying to chase it fast enough to get in front of it, that it makes the price and the payment so attractive that somebody's willing to step in and say, all right, well, I'm a buyer here, you know? And
exactly. And that's the question, is basically, how good does it have to look in order to get to that point?
Well, I think one of the things that I've struggled with wrapping my head around personally is this idea of the demand, this demand for housing, because there's this shortage that people talk about coming off the back of the GFC, where people didn't build for such a long time. And so there's a shortage of actual supply. And I've never been able to get somebody to really articulate to me exactly how they come to that number, with any kind of sense and relevance, other than, X number of families in existence, X number of houses in existence. Right. And, it doesn't really match up for me, because it's, for me, I've always thought about the lens of like, well, if I was a project manager at Porsche, I wouldn't just say like, well, there's X number of drivers in the US, so we should, there's clearly a demand for X number of Porsches, right? You say like, well, okay, of those drivers, who's qualified, who actually wants it, what's our competitive advantage to deliver a product that compels somebody to buy it, and how do we get in front of those people, right? And I don't think housing is unlike any other product in that way. To say like, what product can we bring to market? What is somebody willing to pay for? What can they pay for, right? So there's a difference between, I would love to have a house. Like, I would love to have a giant mansion with a lazy river in it and a 14-car garage, right? Like, I would love to have that. As soon as you say, well, you have to pay for it, I'm like, I'm out. It's like, not me. And so when you talk about housing demand, I think that's like overlooked. And I just don't, I have a hard time then when you say, okay, well, the demand is driven by affordability, and this affordability thing is real, right? It doesn't matter how bad you want the house. If, a median starter home to a young family is 80% of their income, they just cannot buy it. What's interesting to me is that same equation makes it actually kind of a really bad investment right now from an investment perspective, because in order to also turn around and be an investor in that house and rent the house to them, that means that you also are going to have to suppress the rents for them to simply be able to afford the rent payment, right? Now, real estate, I always say, is idiosyncratic. So it's always a great time to buy a great deal. Just don't get me wrong on that, but there's, I think, a big disconnect in the economy and the way that we perceive real estate. And, like you were saying, it's not liquid. So the price discovery takes a long time. And the last thing that came to my mind was, everyone talks about, when housing crashed in 2008. Well, no, it started to in 2008. It didn't bottom till 2012.
Right.
It took years.
And it peaked in 2006, right? Yeah. So you're talking about 6 years. Mm-hmm. And that's on a national basis. There's certain markets that took 15 years. Yeah. To recover.
Yeah. Yeah. Well, just to find the bottom before it began to recover, right? Because you got a bottom before you can begin to recover. And so I'm really interested to see where housing goes. I'm not particularly bullish or think it's a favorable opportunity set right now to be investing in real estate for a number of reasons, because every time I run the numbers in an objective manner, it just seems like a worse and worse investment with more and more and more headwind. Just the macroeconomic environment around it is really quite poor. One of the things too that I've thought about is when people say, well, I'll buy the house now and I'll just refinance when mortgage rates get to 3. I always think like, well, first off, remember you have to requalify in order to refinance most of the time. But if you think, so the 10-year today is at 10 years at like what, 4.1, mortgage rates are at 6.25. So you have, like 6.35. So you have a full 2.25, 2.25 spread over the 10-year. So in order for mortgage rates to get to 3, you'd have to get the 10-year down to what, 1%? 1%. So to go from even, let's just say 4 on the 10-year to 1, it's a 3% drop in interest rates in the 10-year. Well, what's the effective duration of a 10-year right now, Bob? Like 7? So simple portfolio math would say like, well, you can take your capital and buy 10-year treasuries and you'll make your yield along the way, take no risk and make 21%. And then you could just buy the house. So if what makes the investment a good opportunity is, and fixes affordability, is the price of the home doesn't go up when rates come down, then you still don't want to buy real estate. You want to buy bonds.
Right. Well, because the environment in which you're going to get that affordability to come down is in a weak economic environment. I think the challenge, there's sort of two challenges, which I think the first is that I think people forget, like it used to be that basically like a married couple who was 30 years old could buy with two incomes could buy the median priced home in America, right? I mean, I can remember, in my younger days, kids I went to high school with who were buying condos and, like 3-bedroom condos at 25, 26 years old. Like those days are gone. That demand is gone, right? There's nobody who's 26 years old with one white collar income buying housing anymore, right? Mm-hmm. And so it's true that that inevitably someone will have to buy the housing because, you get married with kids and, you can't be in a 1-bedroom apartment forever. But all that sort of underlying demand that isn't the family demand, let's say, that's all been shifted to apartments because we've had a massive apartment boom. And so all those people are basically out of the market. Like if you don't have kids, like you're not really in the market to buy a house. And you're living in an apartment, which for a variety of reasons might be a good idea because it gives you a lot of flexibility, job flexibility, life flexibility, et cetera. Mm-hmm. And so we've basically totally restructured in the last 15 years, totally restructured the demographics of the housing market. The flip side of that is that, people who are buying houses, like I think a lot of folks are coming to these things and thinking that there's some sort of financial investment. Like a house is a depreciating asset that provides a service, which is a place for you to sleep. And so like mostly people, you should be transitioning to a world where it's like, stop thinking about houses as a financial asset and start thinking about houses as, a depreciating asset that provides a service in the same way you think about a car or something like that. And you should buy something like you buy something that you can afford, and that's what you can do. And there's like, it's not speculative. No one buys a car speculatively, like, despite the Carvana commercials.
Don't say no one, Bob.
Maybe not no one, but the vast majority of people buy cars not speculating like the Carvana commercials about the day-to-day price. Think about a house the same way. That's the right way to think about it. Yeah, because it isn't a financial asset.
Well, you're looking at it for it to provide value, and I think this is a bit further down the crazy train scale, but there has been a incentive by the government to buy a house, right? To buy housing, to invest in housing in the last number of decades, truthfully, and they use the tax code. Right. The tax code is an incentive program, but like, and here's the thing is that I am aware of that people don't talk about is the tax code is an incentive program, but it's also a disincentive program. Right. So you want people to build housing, you give them, bonus depreciation, you let them write off the interest expense against the rents, you let them depreciate the home, right. But if you don't want people to smoke, you put a tax on tobacco, right? If you want people to start driving less for emission purposes, you start putting, road use tax, you increase your road use tax, whatever it might be. Right. So there's a incentive and disincentive component to the tax code. And, it's kind of what the government giveth, the government eventually taketh away sort of idea. and I'm not looking at the affordability crisis and looking at the demographical destruction that's happening. It makes me have some disbelief in a continued euphoric real estate market for decades to come that there won't be any, legislation getting passed or tax code changes that make it unfavorable to invest in real estate, because what they eventually want is for the divestment of, now that you've built it, now that you invested in it, we want you to now divest of it so that it can be sold to people to use in a utilitarian sense of they just want to buy housing as their, a depreciating asset to live in, right? Have it provide, shelter for themselves. The same way that, you buy a car. I think that was a really good analogy, which is interesting because my grandpa was in real estate. He was a real estate developer, and he actually retired as the director of housing and urban development in Wisconsin. And that's what he would always say, like, oh, you want to buy an appreciating asset. You want assets that appreciate in value, right? And like, he wouldn't categorize real estate that same way. In fact, some people think like it's crazy. In the early 2000s, he sold his commercial buildings, and people are like, what are you doing? You never sell real estate, it's like, he sold it and bought like utility stocks, like he was a huge utility stock guy. Well, he like did fairly well. He did fine, right? Like he did fine. And the idea was, look, the IRS code allows for you to depreciate buildings every single year because they are a depreciating asset, right? The value of the structure does decrease, does require, capital expenditure to keep the building maintained. Whereas, utility stocks has, they have some of that same depreciation, real estate exposure, obviously internally in the companies, but they're producing something there's that production, not completely dissimilar to rents, but you have to look at the whole picture, right? Anyways, okay. So that's housing. Let's talk really quick. Let's totally change it up. For anyone that's still tuned into this episode and following along, we may not lose them on this one if they're still following along. And that's the dollar. Like there's a huge global shift that seems to be happening, right? I think no one's denying that. Like the global stage, the theatrics of the Trump administration, the tariff wars, the Ukraine conflict, there is just a lot going on, and now you have the stablecoin introduction. And so at first you had international markets were ripping, which I will attribute largely the function of that largely being the US dollar, absolutely getting hammered first half of the year. And now from a technical perspective, the dollar is getting it's re-strengthening. I think the dollar is on, has put in a bottom. It's got a nice rounded bottom. And I think it's on the march up again is my perspective of the dollar. I think it's re-strengthening. I think the Genius Act and stablecoins actually solidify some dollar strength and dominance on that. But I'm curious to know like your take. You've spent a lot more time around currencies than I have. So that's my caveman approach. I'd love to hear what you think is going on with the dollar and, international investing alongside that.
Well, I totally agree with you. Like most of the strength in international stocks has been mostly a currency story rather than a essentially local currency performance story. I think there's been a big and pretty interesting shift that we've seen in global currency markets over the course of the last 20 years, basically through my career, where if you went back and you looked at currency markets sort of in the 2000s and 90s and stuff like that, a big driver of the market action was around bond yields and dynamics related to that. And basically over time, that sort of demand has become a much less important driver of what's going on with exchange rates. And what's become a much bigger driver is cross-border equity buying. And in particular, what we've seen is developed world institutional investors basically loading up on U.S. assets, U.S. stocks in particular, and doing it in an unhedged way, really over the last 15 years, and sort of passively taking on the dollar exposure, which was a good trade because the dollar was very weak coming out of the GFC. The U.S. was the strongest economy, really, basically since the GFC, and so those investors got the benefit of both stocks appreciating and currency appreciation. And I think the question is, if you now see a world where the dollar is tied to it's basically tied to U.S. equity performance, you're going to see essentially high correlation between those two pieces in a way that actually creates some incentives for investors to move money to foreign stocks, because to the extent that you see U.S. stocks or global stocks decline, you'll probably get a benefit in foreign currency terms more so than you would have in the past. And so, I think that people don't really think about currency in the context of equity market returns, but it's one of those things where when you start to see how the market is shifting combined with where the current level of the dollar is, which is, we're at 15-year highs, it's come down a little bit, but not that much, all things considered. I think there's a compelling story here to be looking globally, not just, partially because of the dollar and currency correlation story, but also because, look, expectations in other jurisdictions are like really low. Like Europe, I'll give you a simple example. Europe, earnings growth expectations in the course of the next couple of years are 0. And the current level of earnings is the same as it was. Earnings per share is the same as it was in 2008. Like, that is pretty depressed. And Europe's, not the most innovative economy in the world, but like, it's growing at 1% or 2% a year. It's doing pretty well. And so I think there's a lot of reasons why it may make sense to look abroad for some of the first time in a while.
But I think like what you're describing though is when you invest internationally. So if you say like, okay, well there's 1 to 2% growth happening in Europe, it's priced at 0, so there's an opportunity set there. This is wonderful for European investors that live their life in euros. And if you live your life in dollars, you have to take on this added complexity of like, you have to get the fundamentals of the local economy correct and the production of the companies on the ground in Europe. And then you also have to get the trade right on the dollar, right? Because you got to
get the currency right.
You got to get the currency right because you got to trade it and convert it back. And if I caught what you were saying correctly, what you were saying is these large institutional funds, sovereign wealth funds, whatever, they have been investing in the U.S. because they could invest unhedged, which saves them a lot of cost, right? Like it costs money to hedge currency. And so what would happen is there was this negative correlation between, stocks, U.S. equities and the dollar. And so when the U.S. equities would sell off, and they were running unhedged by owning them in US dollar terms relative to their local currencies, the dollar would rally, and it was essentially a natural built-in hedge for them, right? And so they didn't. Now what you're observing is like that has your belief is that flipped, and what that caused was international investors in the US got smoked this year because like earlier in the year when stocks went down and the dollar went down, they got like really washed out. So now what you're saying is they're not investing in the U.S. as much because that dynamic is back in play.
Yeah, I think they're not. I don't think that they're not necessarily not investing that much in the U.S. I just think U.S. dollar performance is really is positively correlated to U.S. equity performance. That's
what time frame?
Over months.
Yeah. So like, well, it's the reason I asked the question, Bob, is like, look at like, for my own bias to put it out there, right? Or like disclosure, like I'm long dollar right now in the book. And what's interesting is like, if you filter that through different timeframes, and I'm not one to look at like year by year, that's too long of a time frame for my trading style. So I don't know what it looks like year over year or even quarter over quarter, but month over month, what's interesting is like month over month still has a really negative correlation still, at least from my observation in like a trailing 36 month and trailing 24 month. And then some of your shorter time frame, it starts to weaken out, and it goes to like a non-correlation or a slightly positive correlation. which is what makes it like interesting for me to trade, right? Because I want to trade stuff that's not stocks. Like you want to just own stocks and trade other things is kind of my approach. But I think the dollar is from a technical perspective. So you're a macro guy. I'm a technician. I think the technical perspective on it is I think it found its bottom back in July, and I think dollar dominance, dollar's flowing back in. But again, how long that's stable, I don't know. But my word of caution is, if you're going to invest internationally, like my opinion on it, and tell me if I'm wrong here, is like you wouldn't want to just go by necessarily broad all international, right? Like there's probably targeted opportunities that you could try to take on where you can get both the local performance and the currency trade right together. And not take on the risk that like you buy a good company that does good things, but you get the currency trade completely wrong. And so you still lose money, even on a good investment.
Yeah. Yeah. And that's where I think looking for those places where expectations, I mean, look, all investing in stocks is how things transpire relative to expectations. And, you have real companies that are not in the US that are trading at, P's of 5 to 8 or something like that. Those are the sorts of things, companies with moderate cash flow growth that are trading at those levels, that are that are compelling and interesting. I mean, and not I should also say, and not just foreign companies, but also, certain sectors of the US economy, which are, cash flowing and expectations are relatively depressed, and you put that together, and that could be that's the sort of thing that's a compelling opportunity. But you're right, you need to, it's not just buy anything under the sun that's foreign. Don't just go out and buy VXUS, the ETF. You do want to start to think about where is their value globally, both in terms of the exchange rates as well as the expectations.
Yeah. Well, I think in the US, it's easy for us to, like, I hear this a lot with, I work primarily with people that are regular people, right? They're not sophisticated finance people. They're my marginal client is somebody that, works a normal career, does normal things, doctors, CPAs, nurses, teachers, right? Like they're not
normal people.
Yeah.
They're not, that's what we call
mainstream.
That's what we call that on the coast. We call that Main Street.
Yeah. So I work with Main Street. And I will hear, though, I've heard this since COVID is, the dollar's getting destroyed, the fall of the dollar, right? The dollar, the dollar's going to collapse. And I always have this hard time trying to help them understand, like, what do you really mean by that? What is your framework for what you're saying? Because there's two components to that. And the answer, or the question really is the dollar relative to what, right? Because the dollar in and of itself can't really fall. $1 is $1. It's just, what does the $1 do? And that gives, that is like sort of this, the dollar theory of being the reserve currency of the world is like, it ain't perfect, but it's the cleanest dirty shirt in the laundry, relative to other fiat currencies, right? Relative to the euro, relative to, Japanese yen, relative to, certainly in my opinion, comparatively to the Chinese renminbi, but dollar relative to gold, I think, which is generally what they're really talking about. They're generally referring to this idea that dollar is, and I think most people mean this, the dollar is collapsing in terms of its purchasing power, right? And so what you don't want to do is per se say, well, the dollar's collapsing, I'm going to go invest internationally, because that might not give you the right effect, because you have to take on the foreign currency risk and then convert it back to dollars to live your life still when you want to spend the money. And that trade is a little bit more complex than you want to potentially take on. But if you think the dollar's just, air quotes here, collapsing, then you want to probably just look for hard assets that are going to protect purchasing power across an inflationary environment. And I think so that brings up the trade that's been happening, obviously, in precious metals and hard assets in general. what's your take on inflation right now and hard assets? Is that getting driven by geopolitical, or is that trade getting driven by the market continuing to price in, further inflation across a secular cycle? How do you perceive this?
Yeah, if you look at sort of inflation in the tactical sense, like in the 1 to 2 year time frame, what we're seeing is, to be honest, it's like pretty boring. Like, will inflation be 2.9 or 3.1? Like, there's a lot of nerds on Twitter that are happy to spend their days hassling each other about predicting that. The answer is like measured inflation is going to be about 3%. It's probably going to be about 3% for a while. And truth be told, the Fed doesn't really care about that. Mm-hmm. Meaning it could be 3.1, it could be 2.9. They don't really care. They're not responding to it. They're not really effectively, it's not influencing their policy. And so if anything, what we've seen over the course of the last couple of weeks is that market-based indications of inflation, meaning like break-even numbers or CPI swaps, which is the most liquid instrument in the short-term inflation market, has indicated that inflation is going to fall ahead, mostly reflecting economic weakness more than all the other things that are going on. So, be careful what you wish for a little bit. I think there's sort of a longer term, more strategic question, which is, how are we resolving this sort of generalized over-indebtedness by developed world governments? And whether we talk about the US or whether we talk about the UK or Japan or China to some extent, all of these all these governments have large debt overhangs. And the question is, how are they going to work those debt overhangs down? We don't have a baby boom generation. We don't have post-war reconstruction. We don't have all the great productivity enhancements probably that had existed before. We don't have labor force growth. We don't have a lot of the ways that historically countries have gotten out of that. And so, naturally money is flowing to things like gold, which are reflective of the fact that from a long-term perspective, fiat likely needs to be cheapened relative to hard assets. And, there's going to be ups and downs in that process. But the big picture is, particularly in the West, basically everyone is up to their eyeballs in bonds and nobody holds gold. Like, that's the reality. Go look at a survey of financial advisors, and 85% of them hold less than 1% of their portfolios or client portfolios in gold, which doesn't make any sense from a portfolio construction standpoint, because gold outperforms bonds in 50% of equity drawdowns. So when you think about what's the better diversifier, gold beats bonds 50% of the time. And if you look at just the portfolio statistics of stocks plus gold versus bonds plus gold, they're basically the same over the last 75 years. And so you put that all together and you say to yourself, I think people are starting to recognize that they need to start buying gold in their portfolio, but we've got a long way to go. And so that's sort of more a strategic benefit for gold.
I'll throw it down and shed light on why that is. I believe I've truly cracked the code just in observing the conversations of other advisors. I'm pretty involved in a number of planning communities. I'm very involved in the National Association of Active Investment Managers. I know people all across the country. I talk to a number of financial planners at different firms. I listen to a lot of podcasts. I've read a lot of stuff, and it all comes back to one centralized theme. And really, it's generally this. It's a tough sell to tell somebody that you want to put part of their IRA in gold, because if you do, you're opening up the door for the conversation where they get bombarded by the physical gold people, right? Like that. And that's a whole nother, like scam conversation, I think, to have. Those guys are jokes. But the second component is they can't answer a question about, well, is it going to come back? Because it is inherently speculative if you do not have the core belief that gold is money. right? And so, if gold today, which is at like 4150, and it just goes to 3300 tomorrow, right? And a client calls up and says, "Oh my gosh, Brandon, what's going on?" You can't say, "Well, you're getting a 4% yield, so eventually it'll come back. Things in the economy will change. The bond will trade back at par." You just have to say, like, "Look, there's more sellers than buyers. It's gold." There's not a way, right? Like, and so it becomes difficult to explain why it belongs in a portfolio, and and so because there's that lack of cash flow, right? I've had arguments with very intelligent people that will argue like gold is worthless. Like gold has no investment case. I'm a technician, so I just say like chart go up, good. Like I'm like correlation low, chart go up. This is good. It's like, but that's really that really is what it comes down to, right? It's like it's a tough sell. It's tough to sit with a client and say we're going to make a large, core holding in your portfolio for this reason, and then being able to explain the macroeconomic impacts, the speculative nature potentially, right? Like you don't know China central bank is buying. You don't know that the Congress is going to keep printing money. You don't know all these things, right? But you've got a thesis, and that's what advisors should be doing, is advising people on stuff. Now, most advisors just take the easy way out and say, well, I'll just advise you to buy bonds because and this is what I think they get wrong. They say gold is an inflation hedge. So, why don't I just buy tips instead? Mm-hmm. Right? Like, well, they've smoked tips. Gold has smoked tips. It's like, we don't know why. I don't have an explanation for it. I'm just telling you what the data is, but they just work in this theoretical framework. Well, gold is bad inflation hedge. And I think really what they do wrong and the disservice is they forget to introduce skew into the charts. And so what they say is, well, you can see in 2022 when inflation was at 9, gold was down. So gold is a bad inflation hedge. And there's no credence to, well, what did gold do in the 2 years leading up when the money printing was actually happening? Right. Right. Like what, when the money printing was really getting going, gold was a front runner to that whole thing. As bond yields became more compelling, right, they maybe suck some of the liquidity out of gold. But we've seen since then that again they've front run stuff, and what's interesting is, okay, well, what comes next, right? So gold's not a perfect on a month to month basis like this inflation hedge. Like, oh, if inflation's up this month, gold must be up. It's just not how it works. And I think because of that, again, the second order effect is, as an advisor, it's very tough to have that conversation with clients and help them understand, why they need to own this, the colloquial pet rock, and it's for all the reasons that you're saying, right? It has a low correlation. It does, better than bonds, but sometimes carries more volatility than bonds, but it's not correlated to bonds and it's not correlated to stocks. So it produces this good diversification. Why? I don't know. I don't know a lot of stuff, like I don't know why the earth spins around the sun the way it does. You know what I mean? I got a general idea, and my general idea of gold is for thousands of years, it's been money. You can't destroy it. It's economically infeasible to make more of it, right? There's incentives built into the system that if it gets too expensive, you can mine more out of the ground, right? So it's sort of self-correcting and kind of can heal the money system itself that way. And because of that, you just have centuries of it just is, right?
Yep.
Tough sell though.
Yeah. And I think that I think one of the challenges anytime you're talking about gold is, I mean, I get the reasons why people struggle to communicate gold, because it is, gold is a non-interest bearing currency that has no counterparty. And so that's hard for people to wrap their minds around. It's odd that I think people can get their minds around things like crypto faster and sort of more reliably than something like gold, when gold has 5,000 years of history in terms of its ability the understanding of the macroeconomic drivers of
Yeah.
gold and the reliability of it. When you have 5,000 years of history and different people in different geographies, disconnected geographies that have never talked to each other, all sort of have centered on gold as a good option. And so, it is. I think it's easy, and this is maybe just a little too meta for the day-to-day person on the street, but like, faith in bonds is also a matter of faith in the sense of, like, if the government says that they're going to pay you back 4% in dollars, like a year, that could be worth a lot. It could be worth a little. You don't know the answer to that question. Well,
I think you know the answer. You'll get the cash. What will the cash do for you? What does the cash do for you? But
like, what's that going to do for you?
Mm-hmm.
Like, that's an act of faith too. And so there is something kind of silly about the fact that we have acts of faith in bonds and no acts of faith in gold, right? When look, you want to talk about like, is gold a storehold of wealth? Like, the salary of like a frontline person in the army in Roman times paid in gold is literally the same as it is today. Right. Okay. So you want to say, do you save your purchasing power? Like that we got 2,000 years, right, of saving your purchasing power. Obviously it moves around a little bit. But like, that kind of gives you a sense as to the reliability of it. And either way, like, look at it as a diversifying asset. But I get the challenge. I mean, the joke is I've gently poked fun at my financial advisor for almost 20 years about why gold should be in the portfolio and why it's a good asset. And I'm happy to report that after more than 20 years of hassling him about it, he finally started to dip his toes into the water a few years ago, which was a good trade for him.
Yeah. Well, I suppose that's the benefit of having Bob Elliott as a client. If you're a financial planner, financial advisor that way. I think some of the things people get wrong with gold that I've noticed is they use the historical argument for it's a store of value, right? And in that sense, it's like a track record of it does the same thing, but the results it produces are very much different. And so what's interesting is if you start to change the timeframes that you look at data, and not to like just data mine it, right? Always be careful about data mining. I'm going to call myself out here. But if you look at some catalyst points or some things that fundamentally changed gold or the story around gold, and you start looking at data in and around these time sets, it starts to change things, right? So if you say like, well, what does gold look like after, they confiscate it in the 30s, right? What happens? What does gold look like after they, come off the gold standard in the US, right? After they close the convertibility, right? And you go to a totally fiat system. And so there's all this stuff that people will start saying, well, like, and I just find it goes back to like how far back their data set goes. So like from the 80s, gold does XYZ. And it's like, well, starting in the late 80s, central banks around the world were net sellers of gold for, all the way from like the mid 80s to 2008. They were net sellers of gold or something. Maybe it was the early 2000s when they stopped being net sellers.
Yeah, the early 2000s. That's right. Yeah.
Yeah, it's like they started becoming net buyers in 2009, right? And so, but like, why was that? Well, it's because like there's never been a world that there was fiat currency. Every country was on fiat currency, right? And so as Paul Volcker not so eloquently threaded the needle, through the inflationary pressures in the 70s and 80s, and all the other countries said, "Oh wow, this fiat currency thing can work, right? We don't need our gold anymore." They sell their gold. That's a really big pressure on gold, right? For years and years and years. Well, it's going to make gold look really bad, but what you're forgetting is like, okay, that's a bottom of a, so that gives you a bottom point in the market. And now central banks have been net buyers. You just have to simply ask yourself, in my opinion, right? Like, why are they buying gold? Why are they buying gold again? If they owned it at one point, they unloaded it, and now they're rebuying it. You got to ask the question, like, should I be doing something different, or should I be sticking with my original thesis of I buy stocks because the companies produce cash flows and I get, equity appreciation, and the cash flows can be better than bonds. And I own bonds because they produce cash flow and coupon payments. And I just want to have this stuff with this endogenous cash flow return. That's it. I think you have to be willing to challenge your logic, especially if you're a real person in the real economy that needs access to your capital, and you need to figure out how to smooth out rides in your portfolio without, just sacrificing everything to the upside.
Yeah, I mean, part of what I'd say is that central banks who have shifted from, as you said, selling gold to buying gold are basically no different than most investors, in the sense that they're like radically overweight bonds, and so they're not making the decision to buy gold lightly in the sense of they're staring at a portfolio and they're like, I got bonds and I got gold, and which one should I be adding to of those two things?
Mm-hmm.
And let's just say this, they've done very well on that trade. Does that mean it'll be the case forever? No, but that certainly indicates a level of sophistication that is certainly worth considering.
Central banks, you're saying,
when you're thinking about it.
You're saying central banks.
Central banks, they've traded the gold market well, right?
Well, what's interesting is people forget, like, they are different than you or I, right? Which is they get to print the currency in which they use to take to market and buy the gold, largely. And
most of their demand has been shifting out of developed world bonds, and into buying gold,
right,
from central banks. So that's mostly what they've been doing, is reallocating out of bonds to buy gold.
But they're largely price insensitive buyers. Like, a central bank looking to buy gold doesn't care if the price is 41.50 today, or last week it was 42.10, or now it's 39.50. Like, they're buying, right? And they
look at the price.
Well, if
you look at, for instance, how the PBOC trades gold, like they definitely look at the price and they think about what the price is. I mean, you could sort of say that empirically that they are responsive to the price. So to a degree,
yes, but they're not responsive to, like, we were planning a purchase of, however many ounces or tons today. And because the price is trading up $30, we're not a buyer today. Like, they're looking through the noise on that.
Yeah. They're looking at the 10-year, the expected 10-year return and stuff like that.
They're trading the VWAP, man. Probably not, but, anyways, my point is, though, is like, right, they're looking at accumulating. Obviously they don't want to come to market and pay 10,000 for gold today. Right. And at a certain point, if they're the primary buyer and they stop, that can produce an exogenous shock to the market. But I don't think they're particularly sellers here. I don't think they're particularly sellers any point in on the horizon. Right. And what happens is, as somebody that is not they're a relatively price insensitive buyer, they're not a seller and they're a holder. They do suck the essentially liquidity out of the market to a degree, and they create a bunch of inelasticity in the price, right? In the supply demand structure of it.
Right. That's definitely right. And one of the things that's challenging in gold is that the market is super tight. And so actually what you see is it doesn't take much incremental demand. So like central banks plus sort of standard jewelry demand basically eats up all the incremental supply. Mm-hmm. And so if you have monetary demand, there's just like not that much monetary gold that's out there incrementally produced on an annual basis. So you either have to find other people who are savers of gold, physical gold, or you have to start to get scrap. And that's where the convexity around gold and demand related to gold is just very different than certainly different than things like bonds in terms of why you can easily see 50, 100, 200% rallies, which is that if that sort of thing gets out of balance, literally the people who are going to supply the gold in that out of balance when with high demand are people taking jewelry off themselves and, going to do cash for gold.
Which we haven't seen in the US at all.
Oh yeah. Not a huge amount, although scrapping has picked up in other jurisdictions, particularly the East.
Right. Do you have data set on that? What part of the East are you thinking that's happening?
For the real gold nerds, the World Gold Council produces regular reports, which are great reports, a lot of great data for the gold nerds that are out there. Don't let their beautiful advertisements about gold confuse you. They are nerds at heart, data nerds at heart.
So what is their data suggesting? Like who's selling gold? Because the word on the street is that Chinese citizens in particular are one of the main accumulators of gold right now. They're driving gold because of the currency struggles they're having and their limited access to equity markets, right, and other savings vehicles.
Yeah, that was a big story about 2 years ago in terms of what sort of started the first up move in gold, and now we're seeing an increase in scrapping from Eastern households, whether it be the Indian subcontinent or China, as prices have risen here.
Interesting. I wonder if that has anything to do with the commodities pressure, right? At a certain point, even if you own gold, you can't eat gold, sort of thing.
Maybe.
Right? Like, I don't know. We'll see. Hindsight's 2020. So I mean, summing up, I think if we recapped a lot of what we talked about today, it's like there's softening economic data, there's concerns in the housing market, and there's certainly the geopolitical tensions and risk around, evident in the gold markets. And there's potentially long-term inflationary issues, but in the short term, there's, I'm going to use the word cyclical, maybe inflationary and economic concerns. So what does that all sum up to? Is that, what's sort of your outlook for this next year? Kind of everything honky-dory still, hey, risk manage appropriately. I don't think you're calling for the crash of all crashes. But where you at sort of on the spectrum, without doing an S&P 500 price target, because I hate those.
No, I think anytime you're in a late cycle environment, you have two choices, which is you either got to be real diversified, or you've got to be very effective at being tactical, either you yourself or you have to hire people who are able to be tactical in terms of their positioning. And the reason why that is, as we talked about, sort of expectations can continue to be relatively elevated for an extended period of time. But when things, even in the face of weakening economic conditions, but when things shift, they can often shift quickly. So I think when you're looking at your portfolio, like the question is basically, how prepared are you for a range of different outcomes and for shifting outcomes that will likely transpire over the course of the next 12 to 18 months. And I think most investors today are very, very overweight one outcome, which is like stocks go up a lot, and very underweight basically any other plausible outcome, either through their passive portfolio or by hiring people who can, tactically shift their positions. And so I think that's the basic challenge that most investors have today. And now is a very good time to do that diversification into those strategies that can improve diversification and navigate a late cycle environment.
Well, I think one of the interesting things is that we are, I think if we want to coin this or label this a late cycle environment, this has probably been the best opportunity Main Street investors have had to pick up real diversification and have access to the real diversification that institutions have had. I'm going to give credit largely in part to the ETF wrapper and the derivatives rule change of 2020 and what that has allowed, to come to market in the ETF market. It's way different than what it was just five to 7 years ago. And your ability to design a portfolio with really unique types of diversification is a lot different than it once was. And so it's just great conversation to have. And I will just remind everyone that diversification doesn't mean, you own some large, some mid and some small caps, because that's probably not going to work out the way that you're hoping. That can work out in a really good bull market. But that's not the diversification you're looking for late cycle.
Yeah, that's for sure. Different assets. Yep. Different assets that perform well in different macroeconomic environments.
Different asset classes, like completely different return drivers, not just, don't go from 20 stocks to 50 stocks or 500 stocks to 1,500 stocks and think that that's the diversification, because the economic driver that's, the old saying, what's good for the goose is good for the gander. They all have the same economic driver that make it do good. And the opposite is true, right? Same economic conditions make them all do bad. So, great opportunity. I think if you're coming to the end of the year, visit whether, we're your financial advisors at Ducharme Wealth Management, or you're engaged with another financial advisor. Talk to them about diversification, range of outcomes, and, how could you be prepared for that, regardless of whether 2026 shapes up to be another okay year and a continuation of the bull market, or 2026 delivers a lot of chop, or heaven forbid, a big drawdown. I don't know. I don't know what it has for certain, but I think what your call out is, be aware of the situation. It's worthy of being labeled potentially late cycle, and diversification is well warranted.
That's for sure.
So, and tactical. I like that you put tactical in there too, right?
You got to have some tactical in there. I mean, I think one of the challenges that a lot of folks have is that there are certain environments where, being able to be long and short in different environment, in different assets is the best thing that you can have in your portfolio. And if anything, like, most investors are underweight tactical strategies. Like, they're vastly overweight being long assets, and vastly underweight tactical strategies.
Yeah.
And there's a lot of, as you mentioned with the ETF wrapper, there's a lot of good stuff that's out there that, that is institutional quality strategies that, investors can get access to, and at a much, much lower fee point than, the vast majority of like high cost mutual funds or hedge funds directly, or things like that.
Oh, I'm seeing stuff that is, high quality hedge fund quality stuff that people have been paying. And I'll say some of it is continued to be run in a hedge fund wrapper where people are still paying 2 and 24 very, very, very similar ideas. And now you can get it delivered in an ETF wrapper with a financial advisor. And so even if your all-in cost is still a little bit high, according to what, some people might say is high, it's probably still lower than, traditional mutual fund portfolios. And it's certainly a heck of a lot lower than a 2 and 20 fee structure in an actual true hedge fund. So there's a lot of great stuff to be had in that segment. And you got to just, either do a lot of research on your own or work with a good advisor that is staying abreast of, what's available in the marketplace. So
that's exactly right.
So cool. Always appreciate the time, Bob. You're a gentleman.
Thank you so much for having me. I really enjoyed it.
We will catch up soon. And as always, everyone, questions, comments, jokes, hate mail, it's all welcome. Hit us in the inbox, leave comments. We'd love to hear from you. We'll catch everyone out there.